Here are the numbers for Treasury. 112 billion is what's going on the block. That's 9 billion more than in the previous quarter. Of that, 102 billion is basically the refunding and new cash, 9.8 billion. Most of this work is being done by the shorter end. Three-year note yields, three-year note auctions rather, going up by 48 billion. 10 years by 40 billion, to 40 billion. I'm sorry, these are the offerings. And the 30-year bond, 24 billion are offered. All of those larger coupon sizes than had been auctioned in previous quarters. The quarterly increase that we get is basically concentrated at the short end, which makes sense since long end rates have gone up. The problem, of course, for the Treasury Department is that people are criticizing them for not terming out earlier. They have to pay more, so they are kind of locked in here at the higher rates, rather than being able to take advantage of any falling rates. And they do say that this may be the end of it in terms of raising auction sizes. They may raise auction sizes one more time, and that should be enough in the first quarter of next year. They're going to maintain their bill auction sizes at the current rate, so still a lot of work being done by the short end. By early December, there will be modest reductions to bill auctions as they realign the borrowing needs with borrowing. That'll go till late January, and then they are still working on the buyback announcement. Nothing today on that. That will come a future refunding.
How much are people going to suspect that the Treasury is directly responding to fears about disorderly auctions and some of the volatility that we've seen at the long end of the yield curve?
Well, they likely are. Whether or not it's because Wall Street said it or because it's pretty obvious is open to somebody's interpretation. One really interesting note comes in the Treasury Borrowing Advisory Committee letter to the Treasury Department. These are the traders from all the top Treasury houses around Wall Street. They note that the rise in yields that we have seen in recent weeks is likely because traders are repricing for stronger growth and at the same time for a higher neutral rate from the Fed. They are not putting a lot of weight on the idea that it is the deficit. So Janet Yellen said it wasn't the deficit, and they seem to be agreeing, the folks who deal in these things day to day.